It has been roughly a week since I published my last video where I outlined and entertained the idea of this peak FOMO effect around this basket of Chinese stocks. Especially so when we see some of the greatest rallies in this bear market for 3 years now. So how far or how sustainable this rally can continue on? And it's very interesting because you see a few distinct groups of investors or traders or speculators where some say that they're riding on this momentum. There is also another group that is extremely skeptical of this rally, saying that none of this is fundamentally driven, everything is news or macro driven, which would be unsustainable if the government doesn't deliver. And the third group, where I personally identify, where I'm just a normal layman investor, I'm doing my own due diligence, looking at the market, positioning my portfolio, buying companies that are cheap, especially in a bear market. There's ample of opportunities because they provide you with great discounts and great pessimism, which is kind of reflected in the share price. And when you see your stock portfolio just going up like over the last 3 weeks or so, you really don't know how to react. So to layer in another level of nuance, it's interesting to also see where the Chinese government suddenly takes a very proactive approach in meddling with the financial system, with some of these stock or bond markets and stuff. And just announced on the 8th of October, the NDRC chief and 3 of its deputy chiefs are hosting a press conference to basically give details around policies and how they're intending to support growth. So what am I going to do in this video? I think I'll split it in 2 parts. The first part, I'll basically give you some facts and figures and to cite some reports, mainly from Goldman Sachs and Citi Bank. So on the second part, I'll talk more about investor sentiments, the FOMO effect, how I look at this entire risk reward. And of course, I think over the last 2 weeks or so, I've gained quite a bit of views in addition to my normal baseline views. Initially, I think I'm getting like 5 to 10,000. The last 2 videos, I think I'm getting 15 to 20k. And I think naturally or inevitably, when the group of stocks you're talking about gain a lot of popularity, a lot of people want to know what's going on. They start Googling, they start typing into the YouTube search bar. So of course, I'm very thankful and very grateful for this influx of viewership. And like they said, right, a tree in a forest falls down and nobody is there to witness or hear it. Did it really make a sound? So as creators, of course, we want greater viewership. We want more people to listen to us. But at the same time, I would like to kind of err on the side of caution and to like to identify, or at least I believe that I identify first as an investor, then as a creator. And I don't want to get that sequence mixed up. So of course, I can pump my fist in the air and tell all of you, let's go all in. The Chinese rally has just started. The mother of all rally has not been here yet. And investors get very excited, telling everybody that this is an opportunity of a lifetime, you're going to create generational wealth, we are looking at 5 to 10x from here, etc, etc. If you really think about it, many of these commentaries and a lot of these words or terms that they use sounds very much like what the crypto rally has experienced in 2021. And it definitely gets me a little bit worried. So I'll talk more about my feelings and my thoughts in the later part of this video, to come from a more quantitative approach, to try to back it up with facts and figures. So for the first 4 days of the National Day holiday, spending by inbound tourists using Alipay has increased by around 120% year on year. And the idea of confidence is particularly powerful, especially when coming out from a low base, when sentiments were at rock bottom, people are pessimistic about their future, the wealth effect is severely impacting the consumer psyche, people are feeling much poorer. I guess property prices were going down, the stock investments for some of these mainland investors, they're in a bear market, down 40-50% over the last 3 years. I guess outlook of the economy, there's a skills mismatch, people don't feel confident about their jobs and the prospects of their career. I think all this adds up into a declining and a negative reinforcement cycle. And once there's this huge signal from the Chinese government, I think that really picked up a lot of confidence and people just getting excited about spending money again. So on the reverse, we have people like Ling Ling, who's the Wall Street Journal chief China correspondent, and she said that sources from Beijing said that there are a lot of misunderstandings in the market about what China will do next to support growth. So some fiscal measures are definitely in the pipeline, but nothing as big as some had speculated. So it kind of balanced out the effect where if expectations of more fiscal stimulus and the power and intensity of such stimulus does not come into fruition, then a lot of these new spending effects might not be sustainable and it could just be a one-time jump. So this is something that you probably have to keep in mind. And moving to the next part, where I talk more about the views from Goldman Sachs. So GS actually talked about a further 14 to 20% upside from here if authorities do deliver on their policy measures. Earnings may also improve and global investors' positioning remains light, and they cannot miss this rally, which means that there might be a lot more buying to come. So the recent announcements have also led the market to believe that policymakers have become more concerned about taking sufficient action to curtail the left tail growth risks, which is potentially the lost few decades that Japan has experienced, particularly in a deflationary environment. And to add to this bullishness, Goldman Sachs China strategy gives you 10 reasons to buy China equity. So number one, the government has reviewed its pain threshold and the strike price of the policy put on growth in the stock market. Number two, this time is different in terms of policy response. Number three, don't fight the PBOC, which is extending unprecedented and unorthodox support to the equity market. Number four, pullback risks have risen after 30% gains in 2 weeks, but policy U-turn provoked re-rating trades have seldom stopped there. But in the short to medium term, especially if investors are re-rating the entire basket of stocks, there are probably more legs to run in terms of this rally. Number five, lesson learned from Japan. Powerful and tradable rallies can exist even in a prolonged deflationary bear market. Number six, there are inexpensive call options on growth and policy upside embedded in mid-cycle valuations. Number seven, FOMO has room to run. Number eight, more stimulus is probably needed to turn things around, but the profit outlook has moderately improved. Number 9, the Fed has loosened one constraint on China's stimulus. Number 10, even if the rally falters, China equity still has a place in investors' portfolio. And I think this set of 10 rules coming out from Goldman Sachs might potentially be the new narrative going forward. And a very stark contrast from the previous 2 years where people are calling China stocks uninvestable, and now they are saying that there might potentially be room in every investor's portfolio. And moving on to Citibank's equity report, here's the title. Put all in China for policy combo, US dollar rate cut, and attractive valuations. And here's a quick summary. So the policy combo announced since 24 September comprised of monetary easing, property supportive measures, and equity market endorsement. After seeing the government's sharp 180-degree turn post-COVID, Citi Bank thinks that the government may launch more economic stimulus than market expectations. And their baseline assumption is a renminbi $3 trillion consumption support package soon, plus US interest rate cuts rendering more flexibility for the central bank to do more rate cuts. So valuations are still attractive, with a 25 to 30% of their overseas institutional investors having overweight China based on their marketing in Japan last week and communications with the US and European investors. So their sector rotation top picks are overweight consumer and internet, neutral on properties, and underweight on telecom and utility. So the valuation after recent rally shows that the Hang Seng Index forward PE is still near a -1 standard deviation, while the CSI 300 and the MSCI China forward PE is near its historical mean. But they still do see some upside here. So after all that said, I'm quite interested to know what are your thoughts and your feelings, especially as a fellow retail investor. So feel free to leave in the comment section down below as well. But just to share, based on my own feelings and thoughts today, I'm not going to lie, I also feel a certain level of fear of missing out or FOMO effect. And I think it's inevitable, specifically with this advent of social media and people just spreading their conviction and talking to a camera, and they're able to influence thousands, hundreds of thousands of people, especially back in China when their followings are in the tens of millions of people. But that said, I think it's funny and it's interesting because a large part of my portfolio, I've already positioned them in the Chinese exposure. I have more than 60% there. And I still have this FOMO effect. At the back of my mind, maybe I'm thinking that, oh, I could have positioned more to the Chinese equity space. Why keep it at 60%? Why not buy more? Why not start going to leverage? Try to make as much money from this so-called generational wealth building opportunity. But I think here's the ultimate kicker. Emotions are going to be your worst enemy as an investor. And if you're unable to press it down, I think you're not going to have a very sustainable career or a sustainable run in terms of your investing journey. So that's why I have been putting off a lot of my decisions, and I don't want to make decisions in this crazy euphoric market.
So Editor Chicken here, so I just wanted to emphasize on the idea that I try to put off any discretionary decision making, especially when emotions are running high and when the market is not necessarily performing quote unquote under normal market conditions. So I'm not discouraging anybody from making any decisions within this time period, but I think it's a more prudent approach in trying to take things slow, especially when the environment is evolving very quickly.
And over the last 3 weeks, especially in some of these core positions, in this Hong Kong Chinese market rally, daily it's fluctuating up and down like crazy. And I choose to withhold any discretionary decision making until I see some sort of stabilizing. But the fact of the matter is, I'm okay with losing out on this so-called potential additional percentage gains, but at least have a repeatable process and to be able to back my decision based on logic and not so much be swayed by my emotions and this so-called greed and fear of missing out and stuff. Because I do believe fundamentally that any gains or losses that are being made with the premise of greed and the premise of fear of missing out is a wrong premise to begin with. So it's really this 2x2 matrix where you have right decision and right outcome. That's when you are deserving of making money. And right decision, even with the wrong outcome, means that you might be able to tweak your process. And the worst thing is really a bad decision and the right outcome, meaning you do something crazy, yet at the same time win a lot of money, and even you might win a windfall. But this process is not repeatable, and you just carry on with the thinking that, oh, and I'm a genius and I'm able to profit from this crazy market. So I'm really focusing on this idea of being on the right side of this decision-making process, regardless of whether the outcome turns out right or not. So I also recently posted on both X.com and my YouTube community for my portfolio composition and my unrealized gains and losses. And I wanted to draw a very stark contrast with my last portfolio update, which was made around a month back on the 30th of August. So back then, I think my portfolio had a simple return of basically just calculating the total valuation of my portfolio today divided by the amount that I've put in initially. Back then, it was around a positive 7%. And based on last weekend, it's up around 28%. So I don't know, that's around a 3x or 4x more in terms of simple return percentage. And I just wanted to add a footnote or a side note here. I'm saying that I don't want to feel 28% smarter and just laugh at people. I'm saying that, oh, have fun staying poor. Because when my portfolio was down 20%, I don't want to feel 20% dumber. And I would want to believe that my investment philosophy and process is grounded in something sound, in something logical, and I'm able to repeat this process time and time again. After this Chinese market rally, I'm still able to hunt for different value opportunities elsewhere. And I think that's more important, specifically for someone of my profile that is younger, and we are in the stock equity investment space where we do security selection. I want to be able to repeat the process. I don't want to be a one-trick pony and to just figure out one way and to make generational wealth and then say that, oh, I'm done, I'm going to put everything into fixed deposit. And I'm also very, very wary, especially in this kind of very crazy amount of rally, where I can make a video and tell people that, oh, look at my returns, I'm up 20-30%. But it's not necessarily a very healthy way or a sustainable way of appreciating in terms of your wealth, unless you are really able to find this repeatable process in trying to see this kind of 30-40% gains on a yearly basis sustainably. And I would definitely stand corrected if we see some sort of a very strong or very heavy pullback in this Chinese equity space, especially so when I'm not taking profits and everything is on an unrealized basis. But of course, I still have my very long-term thesis on why some of these Chinese tech companies, specifically Alibaba and Tencent, will be big winners in the following decade. So I'm kind of stuck between a rock and a hard place. Because I want to be bullish, and I am bullish over the last 2 to 3 years, and I still remain bullish. But I don't want to give off the impression to many of these viewers, especially those that just came in, the newer ones, and tell everybody to, oh, you should go all in, you should throw in the kitchen sink, just leverage and buy everything because you don't want to miss this opportunity. I don't want to give you that impression. But at the same time, I am bullish and I still am bullish about it. And I do believe that the calculations or the numbers that we are crunching 2 years back, or at least during the bear market, versus today, the calculations are vastly different. When you look at it from a risk-reward perspective, the value at risk model, whatever fanciful model that you see there, where I was buying in a depressed environment, because let's not forget, it was a bear market for an extended, prolonged period of time. I had a lot of time to accumulate. Some of these numbers that we crunch, it was naturally an easy buy. And back then, including myself, many investors are pounding on the table, saying that they're grossly undervalued. It's an easy double from there on. So the fact of the matter is, after this recent rally, some of these names have already doubled or tripled from its lows. And then when you want to come in as a new investor and asking, is there an opportunity for it to double and triple again? I think the short answer is, if you look at this business and you apply an investing framework, I think there is still some sort of a doubling potential. And it's quite an easy double as well, if you just judge it from an individual business perspective. And of course, I'm not saying that the entire index would double again from here, but I'm just very bullish on some of these specific companies that I've a vested interest in. But really, the consideration here is very different, especially when I'm buying in a depressed environment, where right now, if you're intending to start a position, we are in a very get-rich-quick environment, and there's a lot of hype, a lot of FOMO. And today, the game has completely shifted. And everyone seems to just buy for the sake of FOMO because they expect prices to be lifted up again in the next trading day, because we just see green candles after green candles for some of these major Chinese-related markets. So I won't discount the fact that I might potentially make some portfolio moves in the coming few weeks if I feel uncomfortable. But I think there's still a lot of room to run. Which then begs the question again, are you an investor or are you a trader? So for traders, I think you are trading on price action, you're trading on momentum, you're trading on pullbacks, you're trading on just bull market rallies and bullish sentiments. So for that group, I really have no comments or I have no advice for you. You are probably much better at playing that game. However, for investors, here's the thing. I think it's interesting where if you have completely no Chinese exposure over the last 2 to 3 years, even my mother knows that they're undervalued. So which begs the question then for those of you that are trying to come in with a new entry, I'm trying to think that, maybe because of this policy shift or because of government regulations, there's this new shift in tone, then you're more comfortable. With that perspective or with that context, then I think that you should probably not be invested in the Chinese market. Because let's not forget, I think many of these risk factors are still present in the Chinese markets today. So if you're just purely buying because you think that there's this shift in sentiments, what if tomorrow, when the Chinese regulators step in with a different change in tone again, are you going to sell out? I think that's not really a very good premise to be in. The new investors coming in, I think their psyche is probably a lot different compared to the old birds or the old investors that were in over the last 2-3 years. We are comfortable with catching falling knives and looking at our stock positions going down 40-50%. I think these new investors swarming in, I don't think they have the psyche or they have the temperament to be able to weather those sort of drawdown. Which goes back to this idea of an expectations versus reality mismatch. And like clockwork, I think there will be a huge or a large group of investors that will get burnt in this stock market investing game. And likewise, it's not a special product of the Chinese market, but any investing game for that matter, the US market, the Japan market, whatever it is. So to me, I think a bear market is extremely forgiving because it gives investors ample opportunities to study the market and to also add at cheaper valuations. Because by default, the very definition of a bear market is when everybody is exiting the market, you have more than a 20% decline. Especially when you're in those sort of tough environment, there's a lot of very bad expectations being priced into the stock itself. The reverse, in a FOMO market, that is particularly scary. Nobody knows whether is it fundamentally driven or is it driven by momentum and hype and people just entering the market because they're afraid the stock to keep going up even higher the next day. On that note, speaking about the hype, on this Baba thread on Reddit, you have the title, "The Hype is Crazy." So a mainland TikToker with 10 million subscribers openly tells people to go all in on stocks. So the influencer is actually called Da Lan, a lot of speculators incoming. So his reasons for buying the stocks is that, number one, you love the country by supporting its monetary policy. Number two, you can earn a fortune for yourself. And number three, don't let foreign investors buy China assets at low. So some comments on his post include, I already borrowed money against my properties or cars, or borrowed money from family and friends to go all in on China. So he is being very irresponsible and is going to kill many people by telling them to gamble their money into stocks. And also maybe people are going to earn some money in the short term, but most won't be able to exit safely and is going to lose money at last. Most comments aren't about their value investing or fundamentals. So like I said, I'm contrasting the psyche between the old school investors that went into Alibaba, Tencent or some of these Chinese names because of the old school value investing philosophy versus this new age or new group of investors that are buying purely because they are hoping for the share price to appreciate because more people are buying. So that's why I think these new age influencers are really not helping, especially on the ground sentiments in China today, where you have information flow and education focusing on the wrong aspects of investing, where they are not focusing on fundamentals, on doing investment research, understanding the companies, but more so mostly talking about speculation and hype. No longer talking about 2 times or 3 times your money, but 10 times or 100 times your money because of this new age investment flows.
明确告诉大家 ，A 股未来能够走出10倍、100倍的行情的，不再会是茅台还有宁德了，而是这4家处在低位的隐形冠军。
And after having this very extended discussion, so what's the bottom line? What can you take away from this? I think specifically for newer investors, I would categorize you mainly into 2 buckets. I think the first bucket is really those that have been very interested in this space and they've been doing their research, looking at companies over maybe the last 2 years, and they've been hearing about opportunities, but they have not really pulled the trigger. So meaning to say, you are probably well equipped with the different knowledge, understanding of the economy, understanding of the stock market, and you have been waiting to pull the trigger, waiting for some sort of an inflection point, and you are thinking about buying in now. And the second group of investors is really those that have always been skeptical, they have always been afraid of the Chinese stock market, and right now they want to buy in because they feel like they'll be missing out on something if they don't. So I think for this 2 specific group of investors, I think the first part, you don't really need an answer from an external validation point of view. You know that whether you want to buy into Chinese stocks or not. So you should follow your heart and do what you need to do in terms of portfolio diversification, in terms of what stocks to buy. On the second part, really for newer investors that they never studied about it before, and your first question that you ask is probably, should I buy XXX company, or do you think YYY stock at this current valuation still can double from here? I've been getting similar such of inquiries or DMs into my emails or even in my Instagram private message, PMs, etc. My first automatic answer to such a question is really just no, I don't think you should not. And this answer is not because you are talking about Chinese stocks. I think specific to any market, whether it's the Singapore market or the US market, when your question is always phrased in a way where, do I think X company is still worth it? The answer is always no. For those much more serious investors, where they're able to outline a very simple, maybe 1-page thesis, maybe on the valuations, on the business, on the expectations moving forward, and tell me to instead critique that idea and to maybe point out loopholes in what they're thinking, I think those sort of more thoughtful comments and thoughtful discussions have more merits compared to, do you think Alibaba or do you think Tencent is still a buy at today's prices? And moving forward from here, I think discussions between investors in the Chinese investing space will probably graduate from the hype and the momentum inevitably, because no stock market can just keep going up 45 degrees to the right for an extended period of time. But I think really in the meantime, for myself at least, I would just refrain and to ban myself from any activity. I don't want to be caught up in both the hype and momentum, yet at the same time, I don't want to make a very irrational decision in this very clouded, very noisy market. And of course, I'm going to keep my decision-making framework fluid. Never say never. I won't say that I don't want to take profits. I also don't want to commit to the fact that, I'm just going to hold Alibaba for the next 10 years and just close my eyes, especially if things might get a bit lofty and crazy in the meantime. So with that, I do hope that this piece of content would make it out there into the sea of ideas of people getting very excited and very hypey. I do hope that I provide a much more balanced approach and what I'm thinking and what I'm looking, and just general thoughts and general advice on how new investors should look at this whole crazy market rally. With that, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye.